When we talk about inflation, we are talking about the increase in prices of goods and services over time, and how it can have both positive and negative impacts on consumers and the economy. It happens when the prices of goods and services increase over time, causing a decrease in the purchasing power of consumers. The rise is measured by the U.S. Bureau of Labor Statistics, or BLS, and is usually expressed as an annual percentage compared to the previous year. A moderate level of inflation, typically around 2%, can be beneficial for the economy as it encourages consumer spending. However, in June of 2022, inflation hit a level not seen in almost 4 decades, as reported by the BLS. This has resulted in increased costs for essential goods and services, making it more challenging for individuals to afford their basic necessities. In this video, we will be talking about the 10 most common effects of inflation. Number 1. Causes higher interest rates. Inflation has a broader impact beyond just the prices of goods and services. It also has consequences for interest rates. The Federal Reserve, as the central bank of the United States, uses interest rate adjustments to control inflation. When inflation levels rise, the Fed takes action by increasing the benchmark federal funds rate, which in turn leads to higher minimum interest rates. This change in monetary policy aims to reduce the chances of risky or volatile investments. However, it may also make it harder for borrowers to afford even the most secure investments. Number 2. Encourages consumer spending. When prices increase, consumers often choose to purchase items that have a longer shelf life or take advantage of upgrades and improvements they may have previously put off. For instance, individuals who are considering purchasing a new TV or washing machine might opt to make the purchase now to avoid potential price increases in the future. One consequence of higher consumer spending is a decrease in household savings. Many consumers fail to recognize the importance of retaining cash when its value is diminishing. Fortunately, there are investment options available that can help safeguard your funds in times of inflation. It's important to ensure that inflation, or concerns about it, don't unnecessarily affect your retirement savings or long-term goals. 3. Makes debt repayment easier. When you have a mortgage, car loan, or business loan, inflation allows you to repay your debt using dollars that have decreased in value since you initially borrowed the money. This information is particularly beneficial for individuals who have loans with a fixed interest rate. For instance, let's say you have a monthly car payment of $550. If the annual inflation rate is 7%, the $550 payment you're currently making would be equivalent to $585 in last year's money. The payment amount you make stays the same, but the lender is actually receiving less value over time. 4. Increases economic inequality. During times of inflation, low-income households and workers earning minimum wage are disproportionately affected. As the cost of essential items continues to rise, individuals are finding themselves allocating a greater portion of their earnings towards food, fuel, healthcare, housing, and other essential needs. Conversely, affluent households who possess assets like stocks, real estate, or gold enjoy the advantages of inflation, given that these asset prices consistently exceed the inflation rate. Their owners are able to generate substantial returns and increase their wealth. It's unfortunate that those who are less fortunate have to spend a larger portion of their income on basic necessities, while the wealthy continue to increase their wealth, contributing to economic inequality. 5. Lowers unemployment. Some people believe that a higher inflation rate might have the potential to lower unemployment. The reasoning behind this is that when inflation is high, it leads to an increase in the money supply, which in turn drives up demand. As demand rises, businesses will need to expand their workforce. Based on the Phillips curve, created by economist A.W. Phillips in 1958, there is a consistent and opposite relationship between inflation and unemployment. When inflation goes up, unemployment goes down. However, there has not been a clear correlation between inflation and unemployment since the 1970s. Despite the impact of the COVID-19 pandemic, labor participation in the U.S. did not bounce back despite the presence of high inflation. Indeed, Federal Reserve Chair Jerome Powell acknowledged that the Phillips curve has nearly flattened, indicating that the connection between unemployment and inflation has diminished over time. 6. Loss of goods and services. During inflationary periods, certain industries tend to thrive, while others suffer. Sectors such as supermarkets, petrol stations, and funeral services are examples of businesses that continue to generate revenue as people cannot delay their spending indefinitely. However, there are also industries that are severely impacted and face significant challenges. That's because during periods of high inflation, consumers tend to prioritize spending on essential products and services while cutting back on non-essential ones. If your car needs repairs, you'll be able to get it fixed. You will continue to spend money on food. However, it may not be advisable to bring your children to a trampoline park. Instead, you could consider taking the kids to a nearby city playground that doesn't require any fees. Decisions like that can be easily comprehended when prices are high, but as a whole, they have the potential to harm certain sectors of the economy. 7. Stimulates short-term growth. Inflation is caused by an abundance of money circulating in an economy. This excess supply stimulates increased demand, which in turn promotes higher levels of consumer spending. Spending more on consumer goods and services helps boost the economy's growth. Therefore, a moderate inflation rate stimulates economic activity and boosts short-term growth. Nevertheless, when inflation increases and persists over an extended period, measures like raising interest rates are implemented to control spending and slow down economic growth. 8. Introduces risk of hyperinflation. Hyperinflation is a severe form of inflation that can have devastating effects on economies. Although developed countries are generally not at high risk, they are not completely immune to these significant increases. Hyperinflation occurs when there's a significant and sustained increase in inflation over a period of several months. It is often caused by ineffective monetary policies and unpredictable economic policies. 9. It affects lower-income people. Individuals with lower incomes allocate a larger portion of their earnings towards essential expenses such as food and fuel. Consequently, they are more susceptible to the impact of price increases on consumer goods. Additionally, individuals with fewer assets are less likely to experience an increase in their value during periods of inflation. 10. Lowers currency valuation. When prices go up, the value of money decreases. When the value of currency decreases, it means that you need to spend more money in order to purchase the same quantity of goods and services. From 1980 to 2019, the value of the US dollar decreased by more than 50%. It's important to note that the purchasing power of money has decreased over time. In other words, the same amount of money you had in 1980 can only buy you half the quantity of goods or services today. In addition, amidst the pandemic in 2020, the value of the dollar decreased by 1/10 in comparison to the euro. How is inflation measured? Statistical agencies calculate inflation by assessing the present worth of a collection of different goods and services that people use, known as a price index. Statisticians compare the value of the index over one period with that of another to calculate the rate of inflation over time. By comparing the inflation rates of different months, we can determine the monthly rate of inflation. Similarly, comparing the rates from year to year allows us to calculate the annual rate of inflation. The Consumer Price Index, or CPI, is published by the Bureau of Labor Statistics in the United States. It tracks the expenses of urban consumers for items purchased directly. The CPI is divided by the region and reported for the entire country. The PCE Price Index, published by the U.S. Bureau of Economic Analysis, considers a wider range of consumer spending, including healthcare. Additionally, it takes into account data obtained from business surveys. How does inflation affect your daily life? You may have noticed significant increases in prices across various expenses, such as groceries, utilities, and even your mortgage payments. Executives and corporate leaders have also had to grapple with the impact of inflation, finding ways to safeguard profits despite rising costs for raw materials. However, inflation does have its positive effects. In a healthy economy, annual inflation usually hovers around 2 percentage points. This level of inflation is generally seen by economists as a sign of pricing stability. When inflation is within this range, it can have positive effects. It has the potential to stimulate spending, which in turn can boost demand and productivity during times when the economy is slowing down and requires a push. However, if inflation starts to outpace wage growth, it could indicate a challenging economic situation. What do you have to say about this? What do you think about inflation? Drop your comments in the comments section below. Make sure to like this video and subscribe to the channel for more information. Remember to share and click the notification bell.